let's invite two more guests now. Govindarajan Chellappa from Jefferies and of course Nilesh Shah from Envision right here in our studios. Good morning to both of you. Govind, what's your sense from market's point of view? What's the most important issue? Is it the issue on capital gains taxation, or are you looking at something else?
Yeah, I see this budget is slightly different from what we have seen in the past. I think all of us, including the finance minister, is shooting a bit in the dark. We still don't know the exact impact of demonetization, both on economic growth as well as on tax collections. We have very little idea right now about the impact that GST implementation will have on both tax collections and growth rates next year. So most of the estimates that the finance minister would be making in this budget need to be taken with that element of risk. So I don't expect any major changes, certainly in indirect taxes. Maybe some tinkering with service tax rates, but that is best left to GST Council in my view. So largely no big changes in indirect tax rates. Direct tax rates, there are expectations of corporate tax rate cut, as was committed by the finance minister 2 years ago, and that could come through. There is a lot of expectation on personal income tax. Now, I think there is a political sense to increase the minimum slab, but I don't see any logic for cutting tax rates as such. I don't think personal tax rates in India are high. Relative to other economies at similar stages of development. So you could see some increase in personal, the minimum slab, but absolute tax rate, especially with such huge uncertainty, is, I think, a bad idea. The only message to me from the budget, therefore, would be the intent on where the fiscal deficit goes. If the intent is to keep on the track of fiscal consolidation, that would be good. Anything else would need to be taken with a bit of caution.
Okay, so just one number that you're going to watch. 3.2, 3, 3.4. How would you react?
See, I think the absolute number is irrelevant because there's a huge risk to that number, as I mentioned. We don't know what the tax collections are going to be. So to me, the statement of intent is more important than the absolute number. The commitment is to go to 3% in FY18, as was committed earlier. If it's close to that, I think it's fine. It's the messaging, it is the wording that matters rather than the absolute number.
Okay. Nilesh Shah of Envision is also with us. Nilesh, exactly the same question to you. What's the 1, 2, 3 statement or numbers that you will watch out for today?
I think some of the very obvious ones are clearly the fiscal deficit number. I think that's clearly going to be the most important, the paramount number that I think everybody will be looking forward to. 2 is any increase in the allocations on the social sector. Clearly, I think more importantly, the rural sector. I think that's clearly where the big allocation could happen, be it enhanced allocation for Manrega or rural housing or rural roads. I think that's the second big number. And third, I think, is basically the number on indirect tax collections, because clearly that will reflect the confidence of the government in terms of the rollout of the GST. I think there are apprehensions right now, both in terms of the time frame, as well as what the tax rates could be and whether it could kind of, in a way, affect or jeopardize collections in the very short term. So I think that number of indirect tax collections, I think, is going to be very, very important as far as this budget goes and as far as this year goes.
Okay, the market is, by the way, moving up, courtesy the intraday recovery in ICICI Bank. That stock opened 2.5% lower, but is now trading at the high point of the morning and down just about 0.5%. Nilesh, good morning. We've discussed a lot of budget issues. Just wanted your thoughts on what's playing out in the private banking space. We have now Axis and ICICI's numbers. We saw huge positive reaction to Yes Bank, IndusInd Bank and Kotak's numbers, while Axis and ICICI are a bit down. Do you get a sense that we're back to the same old adage of buying the retail banks and selling the corporate banks?
Clearly, from a growth perspective, that's really the space which is demonstrating growth, delivering on growth. And it's still the same names which continue to deliver, while the names which have been stuck with asset quality, I think the issues of asset quality still persist with them. But what it looks like, and I think when you hear the managements of these banks, it looks like that probably they're nearing the end towards the asset quality woes. It's quite possible that you might still see one more quarter, which is basically the March quarter, where the asset quality woes could persist. But I think beyond that, it's hard to kind of comprehend or imagine that these woes will persist. And I think they could get back onto the growth path. So maybe between now and maybe April, May, when they announce their full year numbers, is you could see further stock dips. And maybe at that point of time, it might be a good idea to kind of really buy into some of these larger private banks where the stock prices have been underperforming because of asset quality. And I think post that they should be getting back onto the growth path. I think those investors are looking out for pure safety in terms of growth performance and all. I guess the banks which you mentioned earlier, I think they remain good candidates. Obviously, of course, valuations still remain a challenge with most of these banks when they're trading at 3 to 4 times price to book.
You only buy the private corporate-facing banks, not the public corporate-facing banks?
Yes, I think because there the structural issues remain, systemic issues remain with these banks, both in terms of their capital requirement, the fact that they need loads of capital to basically kind of comply with the Basel norms. So that's one. Overall of the management structure, talent, I think all of that, a lot of the softer issues need to be addressed out there. And whatever the government has, I think, announced over the last year and a half, not all of that has got implemented in totality. So I still believe that these banks face certain structural issues. So I clearly believe that a better idea would be to play the private sector corporate banks versus playing the public sector banks.
Okay, by the way, Infosys is now dragging markets a big time, 2% lower now on Infosys, and that's the reason that the Nifty is now up only about 8 points. Nilesh, almost 52-week low. We were discussing this on results day. It was 896. It had touched. What have you made of the recent move in the US, the IT bill, and the kind of derating that we have seen now again?
I think clearly the latest move by the new administration, I think, is clearly negative. It's not that these companies are going to fall off the cliff. But clearly there are going to be implications in terms of margins for these companies for the next 2 to 3 years. It's going to take some time to them to kind of adjust themselves to the new reality. And as I said, it may not mean tremendous loss of business, but I think it's definitely going to mean some hit in terms of margins. It's going to take some while for them before they adjust themselves as they hire more locals in the US, as they tweak their wage bills, as they do more offshoring, as they kind of deliver through cloud and artificial intelligence. But these are things which will take time. It's not going to happen on an overnight basis. It could take 2 to 3 years. And therefore, we should be ready to see some impact on the margins. But I think the reality also is that you're getting these stocks at virtually, maybe a 20, 25-year low in terms of PE multiples. You've never seen these kind of companies available to you between 11 to 15 times or 11 to 16 times. That's the range in which the top 3 or 4 IT companies are trading at. And I think the best thing some of these companies should do is to go out there and announce buyback. They're sitting on loads of liquidity right now. And I'm quite sure in this new environment, they're going to see limited investment opportunities. So the best thing for them to do in this environment, when the stock is trading at 2 or 2.5 decade low P multiples, the best thing for them to go out is to go and do buybacks. That I think would be the best strategy for them right now.
Oh, I thought you would say buy some digital companies, buy some snack companies, get into digital whole hog. Okay, let's see. Actually, I wanted to ask Govind on the actually earnings trajectory. Probably this quarter's earnings, people were prepared for the shock that they actually got. But are you convinced that the growth story, but for this, is intact? Are you saying the third quarter numbers, the expected shock is behind us? And now we will start to see a gradual improvement in earnings, fourth quarter, next quarter. What's your earnings forecast itself, FY17 and FY18?
Yeah, actually, I'm convinced of the opposite. If you go back in history, usually around big events, you see earnings impact coming with a huge lag. So I think it's a bit too early to look at last quarter's numbers and say they've been better than expected and therefore call for normalization of things quite quickly. Look at real data points. There isn't a single industry that I can think of, with the probable exception of accounting firms, whose business isn't slower today than it was from April to October. And this includes automobiles, this includes cement, this includes credit growth. Almost everything is running slower today than what it was between April and October. Now, not all the impact of demonetization was visible in the December quarter, because the first half of the quarter was actually quite strong. The festive season fell in October, and therefore sales during the festive season did skew the overall numbers. You will see the lagged impact of the slowdown because of demonetization in the March quarter and June quarter and probably beyond that. So to answer your question, the reason I said I'm convinced of the opposite, I don't think we've seen the worst of demonetization impact. The earnings impact will actually flow through in the next couple of quarters. So the earnings expectation for the market is still way too high. The first half earnings growth for the current fiscal was flattish. I mean, depending on how you calculate it, was between 0 and 3%. The expectation for FY17 consensus is about 12% now, which would mean that second half should be 20% plus, which is clearly not going to happen. So there is a big downside to earnings expectation for FY17. FY18 earnings expectation is 18%. Now, there is almost no certainty on any of the parameters as we get into FY18 rather. There is a big event in terms of GST. There is still a lagged impact of demonetization. So to have such a high confidence on such a high earnings growth rate in next year, I think is a bit too optimistic.
Okay, by the way, we'll discuss budget as well, but really the space to focus on now is IT because Infosys, of course, is down 1.5%, but look at the most impacted companies. Mindtree is down 1.5%. Tech Mahindra, we've spoken about in terms of its EPS sensitivity. That stock is down 1.2%. Aditya, the same question I asked Nilesh, but let me just add one more bit. The valuations could be interesting here, but is there a risk of a big EPS downgrades, especially for say FY19, which could again throw even the valuation argument haywire?
For the IT space?
For the IT space.
I think yes. I don't think it's going to be very big or very hugely discrete, but I think the tendency that you've seen over the last couple of years for earnings to start edging down, I think that is actually very, very real. So to
you
that
agree
extent,
with what Govind is saying?
to some extent, yes.
IT.
No, this is IT, but I think this applies for the whole market. In India's case, though, I think the challenge is going to be more front-ended in the current year rather than FY19 and FY20. Whereas for IT, I think the scare is more upfronted. But the risk is that, over FY19, over 20, there's going to be a little bit more of a challenge. Because if whatever Trump is suggesting actually happens, it's not the stock impact can be upfront, but the earnings impact will tend to be a little bit more gradual.
Okay, so that's contrary opinions we're getting. Nilesh, what's the opinion on earnings for the entire basket? As Govind is saying, would you be wary that there are negativities, demonetization, GST, and others' sheer lack of growth momentum?
I clearly believe it's more to do with the growth momentum. And I think that's the big area of worry. It's not so much about demonetization or GST, because those are still things which are in a way short-term events which have come, which have played out. GST will come, it will play out, and I think it'll just be a question of 1 or 2 quarters before which the entire business, trade, community and corporate India adjusts to it and gets used to it. So I don't think that's really the big challenge. I think the big challenge is growth. And honestly, that's the most worrying part of it. And especially after the economic survey yesterday also reiterating growth to be kind of that 6.75 to 7.5% band. I think that is a huge source of worry. I think we should kind of really be targeting 4-8% plus growth. 6.75 to 7.5 is in a way business as usual, which honestly is not the need of the hour. It's not something which we can live with. So unless we get to an 8% plus growth, it's unlikely that earnings would be significantly in a double-digit manner. If you would just kind of add back the numbers, 7% growth, 5% inflation, 12% nominal GDP, that's what the earnings could be in line with. You could still be in a 10 to 12% earnings band even for the next financial year. So unless something big really happens, which lifts growth more towards 8.5%, we probably run the risk of remaining in this, high single-digit, low double-digit growth rate for corporate India.
Okay, you wanted to make a point?
Yeah, actually, I mean, to some extent, to supplement his point, I think there are a lot of disruptions that have happened in the economy, whether it is demonetization, whether it is GST, whether it is what's happening in the US. So when you have so many moving parts, right, firstly, it'll never be very bad, but it'll never be very good. So I think in some senses, you tend to move down a little bit. I think the second thing that happens is risk appetite tends to diminish. Business as usual is absolutely fine. You'll get plenty of that, and some of the growth or numbers being a little better than expectations. I think that continues. But you're not going to get the risk appetite for big investments tending to happen. And that's why, if you remember, I mentioned initially, it's the consumer rather than the corporate, because with the corporate, it's more discrete. And, corporates have to overthink.
Absolutely.
Consumers have to just look at what's working with their wallet. And I think that's where the bias should be. because that's the only way you can start pulling yourself out of this current mid-level growth kind of
But
scenario that you've got into.
I just wanted to throw in a few numbers before we take our mandatory break, to buttress what you and Govind have also been saying. Yesterday, we got 3 or 4 numbers which were not looking very good. We got last year's final estimates, and that is 7.9% GDP. This year, we are probably going to saddle with 6.5 to 6.7% GDP. For next year, and this is an upward bias. That point went unnoticed. What the chief economic advisor was saying is, we don't have tools to measure the informal sector, so we apply the formal sector rules, and therefore even 6.7 would be an overestimation. Yeah. And for next year, actually, his base is 6.75 to 7.5. So it really is not looking like a very sterling growth picture. No. And I take the
Absolutely.
point.
And with nominal inflation coming down, price levels coming down, the natural boost you get to growth numbers from just a higher
the higher EPS will not be there.
That is effectively not there.
Yeah, we have to take a mandatory break, but gentlemen, please